And you prefer A shares versus H shares? Because what we're seeing on the flows front is the opposite, money being pulled out from the mainland. And that's getting reflected in the yuan's weakness as well.
True, but then again, if you look at the immediate short term, I mean, actually northbound investment going into China actually turned in the last couple of days. We actually saw seeing global fund managers actually putting money to work back into the A shares again. So I'm expecting A's to continue to outpace H's and for the H's to continue to outpace the ADRs. And I think that thesis is going to be with us for a while. A, because it's more defensive on the A share market, and there is a different dynamic to it, and to a degree it's avoiding some of the geopolitical risks and tensions that exist, which again we cannot overlook. I mean, without a shadow of a doubt, we've got some systemic risk into the Chinese markets, whether that be the property side, whether it be the credit side, whether it be the currency side, whether it be the output side, the performance side, the GDP number side. But again, from a global asset allocation point of view, I'm still looking relatively positive that as the US and European markets continue to correct, as central banks continue to hike, and as the environment for this part of the world, not just China, but to be fair, other Asian economies, start to look more and more attractive. And I do expect that, again, not calling for the bottom of the market by any stretch of the imagination, but I feel that from what we've seen from clients, especially the international global clients, that people are starting to look again at the Chinese market as an area of opportunity going into the immediate and medium to longer term.
Right, and so being medium to long-term bullish, would you say perhaps, Andy, that it is too optimistic for investors to be expecting that we could see a broad shift in that zero-COVID policy post-party Congress? Is this something they should be looking for perhaps in the spring, as Morgan Stanley, of course, alluded to this week?
100% agree, Sam. I mean, I just feel it's too quick, too soon for us. I mean, the thesis of an unlock or a slight weakening to policy, though, will be beneficial for the markets, I just think realistically is not going to be achieved. And there's been lots of calls whether you can analogize Hong Kong's reopening or unlocking to a degree with the quarantine measures, that somehow that's going to be a softening of stance on the mainland market. I don't think we're going to see that, but I do think over time, and I agree with you, first half 2023 seems to be the predictable level where the potential unlocking or a softening of stance which will allow further growth and further consumption to start to really perform into the Chinese markets. And hence we kind of want to play that thesis going forward, whether it be the consumption or the consumer type side of the market. If you look at the unlock thesis, which people optimistically are viewing now, that's the outperformers at the moment, especially in the ADR market, where we're seeing, the C-trips of the world, et cetera, really starting to have a big bounce. But again, I think too soon right now for potentially at least October, maybe November, December somewhat, but likely more into 2023.